Again, we'll have a very interesting set of presentations following from the morning, which I think provides a lot of food for thought. I think we'll be getting more analysis this time from the financial community, financial perspective. Just a housekeeping note, we're set to have lunch at 12:45. I think we'll allow ourselves to eat into a little bit of that. But if I could just ask the speakers to keep to the time so that we also have some time for questions, because that's a very useful element of these kind of panels. We're going to start off with Ottavio Adorisio from Société. Then we'll have Skim Howard from HSBC. Dalibor Vavruska from Citigroup, and we'll wrap up with James Enck. This independent financial analyst, but I think it's face in these things. We'll start off with Ottavio, and yeah, thanks.
It's better? Okay. So I think it's been a pretty busy morning, so trying to keep a bit more quicker than the way I walk these days and wrap it up in 10 minutes. What I'm trying to do is a different session anyway from the previous one. I'm sure that most of you are policymakers and most of you are regulators, so I don't know how much you do interact with us. We are, let's put it this way, pretty interesting role in the market. We sit there and look around all these different roles of consultants, regulators, companies, and we basically express our view. So we don't actually serve any purpose other than just expressing what we think. And this is what you're going to hear today. So you're going to see that probably I got different views from previous speakers and probably different from the speaker that will follow me. But that's what I think, that's what I will share with you. I'm not going to give any recommendations to what you should do to improve the sector, to improve the welfare. What I'm going to say, or what I'm going to show you, is what your actions are doing to the sector, and what are going to shape the sector the next 2 or 3 years. From there, I think you can probably make up your mind. Let's first think about something that I always like about people talking about telecoms. I'm sure that you should have seen a lot of slides how bad the sector's been over the last 3 or 4 years. But something that probably few of you have realized, they all show delta. They don't show you absolute numbers. Revenues are coming down, margins are coming down. But why we don't say from which level revenues are coming down? There was a slide, if I remember, from Karim, where basically saying the European sector coming down 5 years in a row, and then look at revenues that make network trade in Europe. They're equal to what the US are. The bottom line is that Europe was coming from a much higher level. And that's what's going on at the moment, especially in some particular segments. So it's not all bad what's happening today. It's just that a lot of companies have become just rent seekers, and they have to change. So the good things about pressure is that it makes and trigger a bit of more changes in creativity. So let's kick off with the presentations. I just divide up between 2 key pillars. That's the way we talk about integrated business model, but still mobile and fixed have totally different dynamics. And within mobile, you have 2 different dynamics between voice, that's still the bulk of the revenues for operators, and data. Voice, I don't think I want to stop. You know pretty well what's going on there. NPR has been something that now has been digested in the market. And that's what I'm talking about, delta and levels. Voice revenues are coming down. Karim showed that despite minutes and SMS going up 5-fold, revenue coming down. But the reason why, first of all, pricing coming down is because France was well above any other European markets. Then we compare to the US, it was a totally different universe. Those prices had to come down anyway. They were protected. That's what's happened. US regulator, you take it off something that was a very for competition. You lift and you let the market actually work. If anything else, if you push a little bit the analysis, and I believe that it was Scott that put that into context, if you do adjust for disposable income, actually pricing in Europe tend to be much higher than in the US still, if you basically measure in terms of affordability. There is something that makes Europe different, is the math. What you got in Europe is that in previous years, when prices were coming down, consumption was going up. The point is that European companies have been dragging the feet for so long to decrease pricing. They're doing now because of competition, but they're doing it at the wrong time. Consumers are not investing the cash to actually consume more. You can say that with consumption, despite the big cuts you had on pricing, consumption in some markets, not in Spain for instance, but somewhat Italy, they're actually going down. So we got price elasticity, negative price elasticity. So that's the problem of the sector. There's been a pricing that had to come anyway, and it's happening at the wrong time, in the wrong macro. In the US happened with better macros. It happened 10 years ago. That was the time that people do invest the pricing cut in addition to consumption. So what I want to message to say to operators is that before you blame regulators, I think you probably should have looked this one at advance. You should have acted before actual competition asked you to do so. Let's move on to data. That is a different story. And what I hear from operator probably has some merit. There has been a huge increase in the volumes, a huge toll, and I will see later in terms of investments, but it's not being monetized. And sorry about that one. What I hear more is the reason why it's not being monetized is because European regulator, again, you are too harsh. You don't let the market consolidate. There is not much consolidation. Look at US. US is doing well because it's a different market environment. Now, I think that it was Peter that showed you a particular chart about how many operators we have in Europe compared with the US. 4 in the US, 100 in Europe. But then you have to look from a consumer perspective. Take the 50 biggest city in the US. Each time, how many competitive offerings you have? 4 in each city. Verizon, AT&T, T-Mobile, Sprint. The issue is that each state in the US has 4 operators. Plus, if you put the regional, you got even 4 plus 1. In Europe, we got 4, and in some cases 3. So the key issue is that it's not the fact that Europe is less consolidated, that we're not able to monetize data. The fact is, in the US, the number 3 and number 4 operator are weak operators, has been weak operators. They've not been investing. Network differentiation has been pretty poor. That's what enabled a company like Verizon, in these days AT&T, to monetize data. Also access to a handset, blockbuster handset like the iPhone. I remind you that until a couple of years ago, only the 2 incumbents had those access to the iPhone. That's going to be the case in Europe. Another thing that's important, we talk a lot about spectrum. Spectrum is massively important. It gives you the ability to differentiate the offering. And again, it's true, the 3S pricing much higher than Europe. But then don't forget another thing. What you read on the horizontal axis is a difference in spectrum holding between the incumbent and the small operators. It's huge, or it was huge in the US. That's the reason why competition didn't work there. In Europe, you had new entrants, like of Hutchinson, that had been putting a lot of money on the ground. And that's the reason why it proved difficult to monetize data. Sometimes I hear that now to solve the problem in Europe, it's let's enable the market consolidation. Let's get rid of these operators. You know, it's an analyst. I don't take any part to recommend anything to anybody, but I believe that there is a fine balance between what you wish for. Because actually the US is now moving towards Europe. If you think about what Sprint has done in terms of investment, buying towards potentially T-Mobile merging with some other companies with spectrum, they actually coming towards us. We want to go towards them. One thing our people also talk about, it's, I think I will follow this law to make sure that, but this is basically limiting investments. It's true. We are behind LTE rollout vis-a-vis the US. But it's probably to do also with Scott's side. Because we actually auctioned 800 megahertz 5 years later. There's a clear correlation between when you provide the spectrum to the companies and when they actually do invest. So what I'm telling you is that it's not true. What I'm hearing most of the times, the companies have no incentive to invest. They have all the incentive, especially if competition can work. And this is where the industry stands. I've seen from Karim about the returns on investments, and something that sometimes I struggle because 15 years as an equity analyst, I try to calculate return on investment for a telco company. And my question is, what's the balance sheet for a telco company when I put investment 20 years ago? What I used for capital employed? Current cost, historical cost. What that basically is interesting, look on the EBIT margins for the industry, and you will see that EBIT does include an allowance for CapEx. And I remind you that depreciation is still higher than CapEx in a number of these companies. You can see that the telco sector, it's not basically bleeding. It's basically, before it's true, it was well, probably one of the best. It's going downwards, but still not bleeding. So there are still incentives for investments. It's probably important to make sure that those investments are channeled, where they actually are channeled for the right reasons, not for recreating quasi-monopolies. And this is a very quick one. I think that is important. I've seen also hanging around, it's not all done. What's important for investors is not revenues, it's cash. And EBITDA. I've seen the EBITDA. I put on it in terms of EBITDA margins. That's what's happened to the sectors, whatever companies. Now, on that one, it's a lot to do with the change, again, in competitive landscape. Operators were able in the past to put pressure on answer makers because there was no differentiation whatsoever. The only differentiation among handset was the shape. 10 years ago, that's the only thing that you can differentiate a Motorola from a Nokia. These days, data has introduced a significant differentiations, thousands, millions of applications that sometimes are tied up to the handset, no longer to the network. And that's what really created another big pressure. It's nothing to do with regulators or how many players you have. It's to do with the fact that now you can no longer push onto the consumers the handset you want, but it's the one with the lowest wholesale prices because you get high margins. It's a pool game. The consumer wants a certain handset if you don't provide the churn. And that's the reason why you have to subsidize it. Again, I think that's this competition and I regulate this into the industry, and that's comes down with innovations. Apple has done it and Magnus deserved it. So what the operator have to do is probably try to copy from that particular business model, trying to be more innovative and not just wait for some particular benefits that are coming from a change in regulation. Let me just, that's the second pillar, and I'm trying to be fast on that one as well. That's the fixed line. Fixed line, I have to be honest, I believe that you as a regulator have a role to play, a quite significant role. The trend has been almost the same, in mobile, downwards. But the key issue here is to do with the fact that incumbents face two different trends, or two different competitive dynamics. One was market, cables. The other one was regulatory framework and bundling. Now, let's tackle the first, because that's pretty important. Cables, it's been completely absent, at least up to today. they played a quite important role on shaping and bringing broadband and fulfilling the digital agenda placed medium term targets. They provide good speed, and they've been driving capital intensity for the incumbents. You can see there is a clear correlation between what the incumbents spend in terms of fiber rollout and the competitive pressure they get from the cables. So again, that's positive competition. I don't think a regulator should actually intervene on this one. That, if anything else, unfortunately, the markets are likely to subsidize any further cable rollout. Also, this cable, I remind you, were rolled out during the telco bubble, and I don't think that any investors have the appetite to actually come in and subsidize further rollout. But when they're available, they play a good role to basically trigger investments in this sector. The issue about the cable, you have to be careful, is that the cable played a good role up to now, but they probably cannot play the same role going forward, because the cable themselves have a significant capex cycle that come in their direction. People forget that cables are broadcasters, essentially. They become telco operator in the last 10, 15 years. And as broadcasters, they play on shared bandwidth. What it means is that they got a pretty head start, because when you joined a network where you got shared bandwidth, you got all the bandwidth for yourself. So that's the reason you could provide any speed, any bandwidth at your will. The issue is that the model becomes successful, congestion is becoming a big issue. And you can see clearly when you look at the chart on the right-hand side, on the lower side of it, that yes, they offer 100 megabits, but they don't deliver 100 megabits. They're not able, going forward, actually to do that more and more, because basically congestion is creating an issue. And it will create an issue even more going forward. Because remember, the cables act like airlines. Share bandwidth. They've basically been selling contract through overbooking. So they only provide capacity for a restricted number of the customers, because internet traffic until recently has been web browsing. So what it means, even if you're online, you don't actually download it most of the times. As people move into streaming, it's not just YouTube, it's Netflix. What it means is that you can no longer leverage a network for 1 to 20, like some of these cable players still have. They've got for 1 to 3. It's a 7-fold increase in capacity that the cable have to provide. So on that one, I think you as a regulator, you have to be aware of that one. Because the cable played a significant role, potentially they cannot play the same role going forward on public investments. And then, and this is where I would like to finish up my own presentations, in terms of where the regulation has been more pervasive. That chart is pretty interesting because it shows something. The pricing in Europe, according to this triple play, it was mostly tangible, but it's not sold as a single service. The lowest price in Europe is not in the markets where you got cables. Infrastructure-based competition don't lower pricing. Why? Because, as was said in the previous session, if you invest, you want to have a return. And a return means you're careful with the pricing. The lowest prices is a market like France, where, yeah, you got a cable, but it's not like the Netherlands and Belgium. It's very restricted in terms of coverage. It's a lot to do with the lack of bundlers, things like Helium. And that's a lot to do with your actions. You can see over there that in the US, it's a pretty interesting example when we talk about benchmark. By the way, those numbers are adjusted for disposable income. If we wouldn't adjust, the US would be off the chart. It would be much higher than it is. And the reason is because in the US, it's all down to infrastructure-based competitions. UNIP, as most of you probably still remember this name, was phased out 10, 15 years ago. So that one, I think you have to be careful, because that one you did really shape how the sector has performed by cutting and bundling for almost 50%. So for an unbundler, and that's the reason why some companies have been pure single play. They never really had need to invest in infrastructure. You know, we're talking about companies that have been piggybacking on the potential on the network of the incumbents. Why? Because we pay at cost. You have no risk, and that cost was going down, at least the cost, the wholesale cost, been going down. So that, in my view, I think you have to think twice, especially now that you do have different investment cycle fiber, because that provides a long incentive for these companies. Now costs are going up because of fiber, and that's becoming quite an interesting thing. I believe, personally, that the new attitude from the commissions, and I believe from also a number of regulators when I talk to them, is the right one. You want to basically make sure that a new investment cycle, a big investment cycle, is starting. They're not clear incentive when you look at consumer demand because of the macro, because of disposable income, because of many other different factors. Don't want to go into details. You have to provide an incentive. The incentive enable these companies to earn a right return. But there is a but for that. Be careful how this company actually operates. Peter touched briefly in his presentations about quad play, bundling. I've been in the sector again for quite a long time. Bundling is not something new. They tried to bundle for so long, but as a user, before being an analyst, they never really had an appeal. Never really gained a lot of traction. They started gaining a lot of traction recently with PT, Telefonica. Peter also mentioned France Telecom. And people warned, be careful about the pricing. What they're doing, these companies, and then as your regulator, you have to be aware. They're basically using bundling as a price squeeze mechanism. How you would basically able to assess if the price is squeezed when fiber is bundled with unregulated services, and most of the discount, as Peter mentioned to you, is actually to the mobile. I give you 3, 4, 5 SIMs, as many as you want. They're not discounting the mobile, they're discounting the fiber element. That's what they're doing. And for companies that don't have fiber, BT, for mobile, sorry, they bundle media, and they give you media for free. And they know actually the discount is not on the element that it actually on the retail side, it's on the fiber. And that's the reason why it's difficult for a company like Pure Mobile, that mentioned just one, Vodafone for instance, for them to actually match it. Because if you have to buy something that on the retail market is sold for less, it's a bit of a problem. You have to build long-term solution for short-term problem. This is the market shares that Pure Mobile operators are basically facing. Therefore, anyway, and we go back a bit of excitement we see in the sector recently. And again, I think for a few of you, I think would be, forgiven to think about or probably resolve and look at the sector performance of the last 6 months. I was not driven by financials. Don't be fooled. No investor whatsoever believe that the fundamental industry have been fixed and repaired. What they believe is there is some M&A, you want to position for that one, but they believe that the sector is still healing. So, and as I conclude, I believe that for some particular drivers, things are going downwards for the right reason. For others, probably you as a regulator, and especially referring to the last point, you have a role to play, and I advise you to think twice, because after all, it's really important to shape how the sector and operators will look like in the next 5 years' time.
Thank you, Ottavio. Stephen, do you want to follow on swiftly?
Right, everybody, thank you very much indeed for your time today. Thank you to our hosts. A quick few words of introduction about me. I head up the HSBC Telecoms research team. It's a global team. And I'm hoping to speak to you today about how investors perceive the sector at the moment and how I suspect that perception might potentially be improved going forwards. The question that we were asked to address today was, will telecoms be a rising star again? Plainly, I can't really begin to answer that without a bit of discussion of where things stand today and the picture of the landscape of telecoms today. Some of this has already been covered quite extensively indeed by some of the previous speakers, so I won't labour this in too much detail. Suffice it to say, I'll take you through a set of slides. This shows you the picture of telecoms today, and it's not a very pretty picture. The sector, most investors would tell you, is under intense pressure. It's a relatively fragmented sector by comparison with its global peers. It has higher leverage than most of its global peers. That's a problem, especially in the context of what's going on with the EBITDA trends, that's to say the profitability trends. It's one thing to be leveraged, but if you're leveraged at a time when your EBITDA is consistently contracting, that makes the situation that much worse. Or can we hope that perhaps the EBITDA trends will turn around? Not very likely when that's your revenue trend, so that doesn't look a lot prettier. What do you do in response? Well, you slash dividends. That's been done a long time ago. And here's the crunch, I think, from the perspective of the European citizen. This inevitably, ultimately, has an impact on what you can invest in infrastructure, which should be of acute interest to all of us. So I've got here a couple of charts showing how European CapEx is progressing versus some of our international peers over the past 5-6 years, and we are spending substantially less. The trend is really quite discouraging. I've seen a few charts which look at this on a CapEx sales basis. Do bear in mind, obviously, that can hide the full impact of the trends. If you've got two players with the same CapEx sales ratio, you might think that they're investing equivalently. But if one of them has got expanding sales and the other has got contracting sales, then quite clearly that there's going to be a substantial difference between the investment infrastructure spend of the two. And the consequence of this is that Europe is lagging in terms of its fibre deployment, and perhaps most shockingly of all, given the leadership that we once enjoyed in this space, we're lagging badly in mobile as well. Now, there are a number of drivers behind this, and I would freely acknowledge that things like spectrum availability is one of them. But another driver, and I would argue the most important driver, is that investors don't want the telecoms companies that they own to spend money on infrastructure because they cannot generate an adequate return. And that is a colossal concern, I think, for all of us, given the prominent role that telecoms plays in things like productivity growth, as we heard earlier, which obviously is a key determinant of our economic future as a continent. So I'll just summarise this, therefore, in 2 slides. The first simply shows how telecoms equity has performed versus the broader market over the last decade or so, and I think the one-word summary there would be dismal. And given that that's the case, it's not really any surprise that we are seeing operators trying to conserve their investment expenditure in infrastructure, and that's one of the primary reasons why I think there is very legitimate questions about whether Europe can actually deliver on the digital agenda targets. So therein ends the first part of my presentation. What I'll try to do in the second part is talk about where regulation is today, and what direction it might take in future to respond to some of these concerning developments. And I want to begin really in this part of the presentation to just say it's not all doom and gloom. I think there are some very encouraging developments on the regulatory front that have emerged in the last year or two in response to this environment. If I take a quick step back and look at regulation over the last decade, I mean, quite plainly, and as we just heard from the last speaker, that there was a need to introduce competition into a market that was previously essentially a set of monopolies, and so quite reasonably regulation has concentrated on introducing competition into the system. I guess what I would submit to you, though, is now the case, is that competition has been successfully introduced into the system. We have adequate competition. What we don't have is adequate investment. So I think what's needed is a regulation that embraces both. They are not antithetical. They are not. This is not a dialectic. It's not either competition or investment. Good regulation can embrace both. And this is one of the things that I think we see in a piece of a recommendation recently adopted in Europe, the Non-Discrimination and Cost Methodology recommendation. Now, this is a beautiful thing, ladies and gentlemen. I mean, I think it's a really magnificent piece of regulation. I'm well known for my enthusiasm about it, because it's going to, I think, unleash investment in the sector, but not in a way that jeopardizes competition. And I think that's exactly the goal to which we should all aspire. The key points, well, firstly, it frees the incumbent to determine its own price on fibre. That is so important if you are an investor. The knowledge and the confidence that operators will actually get to set their own prices, but subject to certain caveats, very important caveats, equivalence and the absence of a margin squeeze. So I think that's probably the most important element of this recommendation, but there are two other important aspects that I'd like to highlight in addition. The first of those additional points is that there's also this provision to gently increase ULL prices. And that's very important because fibre investment is a distant prospect. We've heard something about the payback periods involved today already. I mean, for an investor, what they need is some signal more immediately that investment in infrastructure will be rewarded. And I think that stabilising ULL prices in real terms helps to give that signal and reassurance. And the other sort of a really important thing about the proposals is technology agnostic. Well, that is to say, at least it has done away with this rather pernicious distinction, in my view, between fibre to the premise and fibre to the node. So a very encouraging proposal, and one that was very much aligned with the type of reports that we were putting out 2 years ago, setting out what we thought was necessary to stimulate investment. So it answered most of the requirements of our 4 steps of fibre piece that we put out at the start of last year. What do investors think about this particular proposal? Well, most of the investors I speak to are very encouraged by it. They think that this is the right approach in order to actually stimulate operators to go out and deploy some fibre. However, quite clearly, their attitude towards the sector is going to be governed by far more than a single new piece of regulation. And I'm asked to summarise investors' views on telecoms. I'd say roughly most investors recoil from telecoms. Their attitude to it is one of something approaching revulsion. And the reasons for that won't be too hard to discern, given some of the slides that I was showing earlier. So I think the problems that they have, I've tried to summarise here in a few bullet points. We mustn't underestimate the challenge of the hostility in the investor community to this space. Quite a few clients see significant bankruptcy risk within this territory. Almost all investors cite the deteriorating revenues, profitability, the obstacles to consolidation, substantial issues. And they're also very concerned that even when regulation does appear that supports investment, it won't necessarily be implemented on the ground. The bottom line is this. If you want financial markets to commit the quantities of capital that are required to upgrade the European infrastructure, what they have to see is rising revenues and rising ARPUs. If they don't see that, they won't have the confidence to commit the capital. All they see is a perpetual process of contraction, which, as we've heard a few moments ago, if one goes back a few years, perhaps has some legitimacy. If you're an investor sitting here today trying to take a decision about whether to endorse investment by a CEO of the company that you own in fibre or LTE, you need to see growth to have confidence that you're going to see a return on that. And as I'm often fond of saying, let's bear in mind the weighty responsibility that lies on the shoulders of financial investors. They're responsible for your pension and my pension. They have a moral and fiduciary duty to earn a return, and Telecoms has not provided that return. So, I'm afraid at the moment the stance of most investors is, well, I'll just sit this one out, thanks very much, I'll maybe see you in 2 or 3 years' time. Do we have 2 or 3 years? Do we have 2 or 3 years? We don't have 2 or 3 years. Well, perhaps all the above said, I'm nonetheless, perhaps guilty of being a congenital optimist. I do think that we can answer a lot of the questions that regulators hold for this sector. What I'm trying to do in this slide is summarise some of the key burning issues so far as investors are concerned. The first batch really relates to implementation. Is there a sufficient consensus amongst the regulatory community to actually get these measures implemented? There's a lot of commentary, some of it from our esteemed moderator, for instance, around the degrees of differences of opinion and perspective that one sees, even within Brussels, about the way in which regulation should be framed and implemented. And of course there's lots of questions about the tensions between what's going on in Brussels and perhaps at a national layer. So there's a lot of questions around there that we need to work hard to resolve. The middle band of questions, I think, though, in some ways are the most important. I think that the non-discrimination and cost methodology recommendation is a tremendously powerful step in the road to repairing the fixed line market and securing growth and investment there. But if there's one area of the European telecom space where the problems are still very, very conspicuous and where arguably there's no relief in sight, it's on the mobile side. So one question we absolutely got to address if we want to see the mobile operators investing aggressively is how those markets can stabilise and return to a modicum of growth. My view on that is that part of the answer will need to be consolidation, because I actually think the market is, and this perhaps runs contrary to some of the other remarks you've heard, but the market is actually even more fragmented than you might think looking at the pie charts. So what the pie charts don't contain is things like over-the-top competition. What the pie charts don't contain is things like Wi-Fi offload. So actually, I think you've got there a very fragmented market that is in clear emergent need of consolidation. I'll return to that point in a moment. And then finally, I've put at the bottom there a bunch of questions around the new single market proposals. The most important portion of that, in my opinion, is the spectrum proposals. But there are questions there as to whether these will be actually approved and implemented. That is vitally important. I tell you, if you're an investor, that is the one thing you are absolutely focused on. Will spectrum be fairly allocated without discrimination, without asymmetries? If I only impart one message to you today, please understand the absolutely critical importance of revising our policy on spectrum. Right, so as I mentioned a moment ago, I am kind of an optimist that a rational, sensible set of solutions will eventually emerge. And that's really founded on my view that there is a win-win here. Right? There are solutions to these questions that I think benefit all parties, but most critically, of course, they've got to benefit the consumer, the citizen. One of the questions that is so often raised in this territory is about the perceived tension between the interests of the citizen consumer and the interests of the operators. I think that there's much less tension there, actually, than is sometimes supposed, because prices, frankly, in this industry are going to fall anyway. They're going to fall anyway, because it's joined at the hip to Moore's law. I mean, the only question is how prices fall. And the traditional approach has been forms of either direct or indirect intervention, direct by price regulation, indirect by, as one previous speaker put it, shoehorning extra players into the mobile market, but basically forcing down prices by what an economist might term static effects. Now, that will work, but it is much less effective than dynamic effects. And the most powerful driver of cheaper unit prices is actually investment. So I think what actually will deliver the best outcomes for European citizen consumers is a telecom sector that is growing and thus supports investment. Because with investment to the latest generation platforms, it is that that will drive lower unit prices much more effectively than static forms of intervention. And the analogy I generally use is between candles and light bulbs. Right? You can't cut the price of a candle far enough to make it better value for money than a light bulb. By the way, light bulbs are more expensive. They're better value for money. You can't light a factory with candles. So, I'm wrapping. So, as I mentioned a moment ago, I think one of the answers to unleashing that investment, though, is going to be that we're going to need to accept some more consolidation. If we don't embrace consolidation, I suspect others from outside of Europe will do it for us. And I think certainly many politicians would regard that as a somewhat unfortunate outcome. And by the way, I think it's not just cross-border, as we've heard speakers from Vodafone who are well placed to opine on this topic. Cross-border has a role to play, but in-country is actually the way in which you persuade investors that investments in infrastructure are worth making because returns are going to be satisfactory. I've got a slide here finally just summarising the points that I've made. Is Telecom sexy? No. Actually, it's dismal. People hate it. what might sway people that it was sexy again? Well, that will be ARPU and revenue growth. And the key point to make is that that will fuel the investment that our society and our economies need, and actually produce the best outcomes for citizens and consumers in terms of the lowest unit prices and the best services. Many thanks.
A reminder on the timekeeping, but we'll move on to Dalibor.
Thank you, and thanks the organizer. My name is Dalibor Vavruska. I am responsible for emerging market telecom research at Citigroup. Eastern Europe is a very important part of our focus, and therefore I was very pleased when I got invited for this conference. But I was actually hesitant for a while, and the reason was actually the original question, because the original question is about whether telecoms are sexy or not. And I was thinking about cables and antennas and how that fits, and the best answer I could come out is to think about some content or some employees or some projects of some companies outside the telecom industry, but that wouldn't work, and the legal people were not happy even putting the title on the presentation. So I decided to talk about some trends globally that we see in telecoms. I think there's been lots of interesting things said already by the previous speakers. It was focused largely on Europe, so I just try to focus it on, in general on the industry as much as I can. Now, those two charts show the Telecom Index, MSCI Telecom World Index. It's interesting, the last 18 years, it has done close to nothing. In the last 18 months, actually done reasonably well. Europe may not be, I mean, Europe has done well recently as well, but maybe not as well as the rest. But still, there is some excitement coming to the industry. Personally, on the stocks that we looked at in this region, the Central Europe, Russia, etc., we quite like the mobile stories, quite a lot, because of mobile data. And as everyone else, we looked at the Cisco charts, and when you look at the time 2011, 2012, you believe this is huge growth. This cellular data is one of the most attractive commodities worldwide. But for investors, the time to buy this is here, not necessarily here, because then the growth is already being cut, and possibly for right reasons. I think the industry is actually able to monetize a little better than it was expected. Nonetheless, we have seen quite a lot of expectations being built up, of course, already in the mobile data. Now, let me show this. I do not believe too much in these models that telecoms should be banks and that they should be insurance companies, etc. So I actually think that they are in the business of building and selling capacity. The interesting part is mobile, and I think we saw it in some of the questions in the morning. I mean, the fiber investments are complex, at least in some areas. The bandwidth they offer is basically unlimited, so it's a different economy. The governments often need to get involved more. In mobile, in theory, it should work as a market basis. So I think what the problem is that as we go down the demand curve and expand the range of services, we also have to use different technology. This is, by the way, very schematic. I mean, I'm assuming this is not based on a specific model. But what it shows is that when you move down the demand curve, you can actually get to a position when you cut your revenue. I mean, the size of these areas, these rectangles, is basically revenue. And it's very tricky to predict, basically, whether you're going to grow your revenue when you're going to cut your revenue by installing these new technologies. So have some sympathy for your regulators, to the investors as well, and that they actually face these uncertainties, and they need some convictions, they need some predictability to address these, to overcome these risks. this is a chart that we did recently, which we wanted to show what actually matters in telecoms, what investors are looking at. I'll just focus on those 4 factors. I mean, 2 are demand related, 2 are supply related. The way investors look at it is that they look at what is actually priced in. They don't just look at how it works, but how other people perceive it. Earlier this data boom, the cellular data story, it's been a big story, especially in emerging markets. We've been all over it, the last 18 months talking about this in emerging markets. But I'm afraid to say that now it's kind of wait-and-see situation. I mean, a lot of this has happened. We are expecting growth, but is the growth going to be higher than we expected? We're not sure. In the meantime, as we are bringing smartphones to emerging markets, the OTT risk is becoming more relevant. Technological disruption, by that I mean largely the disruption of copper networks by cellular, by mobile or fiber. That's going on as well. And then there are some positive hopes now in terms of industry consolidation also coming from Europe and some of these discussions that we had. In terms of the main risks, I mean, we talked about the growth in the cellular data and consolidation. I think those are the 2 main positive factors. The risk is, as we said, technological disruption and OTT. The difference between the 2 is that technological disruption is something that's contained within the telecom industry. We've had it in the past. The reason why the chart for the global telecoms over the last 18 years looks like that is because you're creating value on one hand through investments in technologies, and you're destroying it on the other hand by undermining the value of what you already have. That's not new. OTT is new. The internet industry was close to nowhere a couple of years ago in terms of market cap relatively to telecoms. That is not case anymore. So I think that's the way to look at this. I have a couple of charts here, showing or attempting to show how the world looks in terms of internet speeds and which of these countries are most at risk. Just a very simple thing. Where you have high speeds and high fixed line penetration, it's harder for the mobile broadband to challenge it. Basically, you have Wi-Fi, high-speed Wi-Fi everywhere. And then you have countries where you have no infrastructure, so there, by definition, you have no disruption there as well. I think the risk is the highest in the middle. This show, I think it also resonates with some of the previous speakers said. The mobile actually speeds are not, I mean, here you see the fixed line penetration and speeds are higher in the developed and lower in the emerging markets. No, it's not the case in the emerging markets because often they leapfrog and go straight to mobile. So it's the weakness of the fixed line is actually a benefit for the mobile business case in emerging markets. By the way, one of the reasons why we were so positive about the emerging market mobiles in the last 18 months or so. Finally, this is the mobile speed relatively to the fixed line speed. And again, you see the markets in the middle are the most vulnerable. In terms of OTT, I don't have any conclusions, any analysis. We are working on it. Obviously, we do have analysis more than this, but I just wanted to flag the main factors. The reason why in emerging markets becoming important is the smartphone penetration is getting to the levels. It's a really mass market. So all these issues about how data is priced versus voice and what's the share of messaging revenue matters a lot. Now, it's a regulatory conference, so I just wanted to say a few words about regulation. I'm aware of the lunch approaching or overdue, so I'm going to skip a couple of these slides. But just to say, I mean, it's my view, personal view anyway. I mean, there are elements of natural monopoly in telecoms. I mean, there is a point of saying that having 3 different technologies, fixed lines to one house is redundant. The same thing with towers. There are some elements of natural monopolies. I think that the issue is that where they are, how you define the markets, where it's better to regulate these monopolies and where it's better to break them, and whether or not some of these policies are attempting artificial competition in places where it may not work. Now, these are political decisions, and I don't want to take views on this. I just wanted to flag that this is the challenge that the regulators are facing. Just to summarize, and if you want, I'll obviously share this document with you, and you can look at more in detail. But I think that the key 4 things that regulators are essentially supposed to do or trying to do is to support competition in the telecom market to bring down the prices and increase the efficiency for the whole economy, but also support the internet industry, which is important as well, to promote technological progress. And what they are doing, whether they should do or not, is raise money for the governments as well through the license fees. So I think in those slides we are basically talking about how it's possible to achieve this, and whether what are the pros and cons of strong push in these areas. Now, just a brief mention of the EU situation. The way we perceive it is that EU has, I think, since its inception, focused a lot on liberalizing things. I think in many areas in terms of service competition, they went much farther than other leading economies, leading markets. They also supported technologies. I mean, the fact that Europe was the leader in GSM, it didn't happen randomly. I mean, it was a result of a policy at that time, which at that time produced that particular result. I think there has been push for centralization to a single market, and in selected countries, for sure, I think that includes Hungary, there is an objective to raise revenue from this industry as well. And I don't want to go through this in detail because I think we've heard it in the previous discussions. All these setbacks, all these issues that the European investment is now lagging. The Europe TMT industry has been wiped out, and what's left is basically telecoms, and they are struggling compared to others. The non-European internet companies are taking a lot of value from this, and there has not been really a meaningful response to this so far. And as some of the previous speakers mentioned, there is the European telecoms are vulnerable to become acquisition targets. And finally, some of the regulations in Europe, for example, acquisitions, consolidations, are very complex. So it's not just a question whether they want and you don't want to allow certain developments, but it's a question of what is the procedure to get there, which I think is simply adding complexity and cost and risk to the industry. What are the answers? I'm not going to tell you what are the answers, and the EU has some plans. I think, personally, I see some logic in these plans. I also think that there is quite a lot of political uncertainties and hurdles, so I don't want to take the bets in terms of how this is going to evolve, but I think there are some elements of this which are certainly steps in the right direction, and I think they could influence countries outside Europe, which are not part of Europe, but they're looking at Europe. When I spoke to my colleague in Asia, I said, we don't care about Europe, we are ahead, right? But I mean, the countries that are closer to Europe, they do care still, even though they don't directly adopt the European approaches. But what I think the key question which I think needs to be answered in an unambiguous way is what should be regulated locally or on a European level, and perhaps to split it to infrastructure and service. Which part are where the national monopolies make sense to call them national monopolies and regulate them, and where you want to force competition, and how do you approach net neutrality. The last 2 things I would say is there are some companies which want to address this by expanding, by investing in retail or utility as a business or banking and etc. So far this has not really produced good returns. I mean, we can see there's not that many of these companies. I see when I said returns, I mean in terms of share price, but I mean if you look at the profitability of the 2 selected companies, you also see what I'm talking about. I think the questions that need to be asked is the right answer for the dilemma whether the national monopolies to escape and do something else. I don't think personally it is. I think there are risks, there are regulatory risks going forward. I think the regulators, the government should really take the challenge of building telecom networks very seriously, And the telecom companies, especially the leading telecom companies, should be the companies who are obviously going to play a key role in that project. If a company decides, if a telecom company decides to be a bank, and by the way, I spoke about the same subject in the year 99 in a very similar conference in Vienna, and then everyone was excited about it. Then I think there's a question of the infrastructure service operation and etc. As I think it was discussed in one of the previous presentations, the telecom business model is different. I think I do not entirely agree that you can benchmark the profitability of the telecom industry with the profitability of other industries, saying your margins are high and therefore you should regulate it. The telecom business has always been about significant capital investment, taking significant risks, and getting rewarded for it through these high margins. In my models, I always tend to have higher capex than the consensus competition. I think that's what the telecom companies should do. But of course, there need to be some conditions for them to make that business case. So I think, the company, the telcos, they should be the experts in this. And if they divert their attention on something else, I don't quite see the exact synergy effects that will justify it. And finally, this is just to conclude. I mean, we basically we were very bullish. We liked the mobile stories in emerging markets. As I mentioned, now that lots of these stocks have re-rated up, we are kind of believe that we are in a crossroads really in terms of telecoms globally. We think that there are definitely reasons for potential optimism coming from the cloud. You know, some new devices like the Google Glass is running, which will stream lots of videos in the street. But we also know that from the charts of the global telecoms, we've seen that it's very easily gets overhyped. When something works, then people just jump on it and they overhype the expectations, which, by the way, happened on the mobile data traffic globally as well. So we think that it's time now to sit down and just look at this in a balanced way and see if the expectations which are now embedded in the market are right and what these threats like OTT and technological disruption will do. Thank you very much.
Thank you. Finally, James. Slightly different from you.
Yes, I'm always the last guy before lunch, so please don't hate me. It seems to be my fate in life. Right, then do I just... Okay. I'm going to take a slightly different perspective. There's a quote from George Bernard Shaw, the playwright, that's something to the effect of, the reasonable man tries to adapt himself to the world, the unreasonable man persists in trying to adapt the world to himself. Therefore, all progress is dependent upon the unreasonable man. So I'm going to talk about unreasonable men and women trying to change the status quo in next generation broadband through the use of entrepreneurial capital. Does that work? So who am I and why should you care? I don't know why you should care, but who I am is I'm a recovering sell-side analyst. I was an analyst for 10 years in the City of London. Then migrated to the dark side, principal investing at Merrill Lynch, and post the apocalypse I've been an independent consultant and analyst, most recently working on corporate development issues with City Fiber, which is a company you've probably never heard of, but I'll tell you about, and also with the BB Glasfaserfonds, which is an investment fund in fundraising mode in Germany. I've also done a lot of other analyst advisory roles. Someone put up a reference earlier to an OECD report talking about the macro impacts of next generation investment. I co-authored that report. I hope it was right. We'll see. Principally, I've been involved in looking at some of the enabling infrastructures around next generation access, principally fiber infrastructure, towers, and data centers. I occasionally produce rants and a blog that I've been running for 10 years. I'm going to focus on fiber, because that's what I've been doing, the thing I'm closest to. This is the oft-quoted fiber to the home or fiber to the building rankings produced by the Fiber to the Home Council of Europe. To qualify for this chart, you have to have at least 1% household penetration on true end-to-end fiber, not fiber to the cabinet, but fiber to the premises or fiber to the building. Lithuania leads this chart. It's an interesting mix at the top of the sort of wealthiest, highest tax regimes. Sweden, Norway, we've had a significant involvement at the municipal level and also from regional and local utilities, but also some names you might not, on the face of it, expect, such as Bulgaria, Romania. The last set of figures I saw, I believe the highest average connection speed in Europe is actually in Romania. So this traditional correlation between infrastructure and perceived prosperity or size of economy seems to have broken down fairly decisively. And there are two names that are missing, Germany and the UK, each below 1% penetration. This is a rather ugly map of Germany. The colors to focus here are bright green and the more muted green. And these show the availability of connections of at least 50 megabits per second. As you can see, it's a very sharp, if you draw a line down the middle of the country, it's a very sharp divide between east and west. So if you're trying to start the next Spotify or the next Twitter and you're in East Germany, you're going to have to move to Berlin to get a decent connection. If you're a town in post-industrial East Germany that's looking to redefine itself or redevelop its position in the economy through interactive services, creative industries, you can't differentiate yourself on the basis of bandwidth because it's not there. And that goes to the core of some of the issues I'm going to be talking about on the company-specific basis, is that there is a real thirst from communities both in Germany and the UK, which I'll talk about in a minute, at a municipal level to try to get different solutions to infrastructure, often involving a third party or a third way. Similarly for the UK, this is another ugly map. The dark green is where this is a projection by point topic of the availability of super fast broadband, which in the UK context means anything north of 24 megabits per second. This is a projection of the likelihood of availability in the year 2015. So dark green is 100%, lighter green is less than that. The orange area, as you see, is somewhere between 50 and 75%, and anything below that is well, Scotland mostly, but also significant parts of the center of the country, again, post-industrial areas where there's a thirst for redevelopment, and infrastructure seems being a key element of that. So there's been different estimates. I think if you went with a full-blown fiber to the premises estimate for the UK and Germany combined, for the sake of argument, let's call it 80 to 100 billion euros. The current levels of incumbent investment don't come close to that. Both BT Openreach and Deutsche Telekom are focused on fiber to the cabinet deployments. Those deployments are very highly correlated to the footprints of cable operators in those countries. So if you live in an area where there's no cable presence, your likelihood of having fiber to the cabinet in the foreseeable future is significantly lower than if you live in a cable area. The cable networks themselves are patchy. In the UK, it's around 50% household coverage. In Germany, I think it's 53%, but the DOCSIS 3 upgrade isn't complete there, so it's below half for the country. And the cable networks really are driven by sweating the assets they have harder. They're not building new footprint. They're not migrating to fiber. They're doing the same thing, trying to win market share within their existing footprint. So in my view, the only answer to bridge this gap is in the form of third-party entrepreneurial capital, and I'll give you a few examples. A lot of people thought these people were crazy. Ricky Fiber in Holland, presumably many of you are acquainted with them. They did in Holland you have ubiquitous cable, something like 99% coverage. It's a small country, it's flat, the terrain's not difficult, so ADSL coverage is very good. They started a direct head-to-head combat overbuild against both cable and ADSL around 10 years ago. The numbers aren't public, but I'm assuming based on the number of houses passed that it's about a 1.5 billion euro project so far in terms of capital committed over the past 10 years. The network currently covers more than 20% of all households in the Netherlands, and their cumulative penetration rate is 30%. Now, if you look at 32, I believe. If you look at their earlier vintage projects, they're north of 50%, and the very earliest ones, they're at 80 to 90% penetration. They were pioneers in a pre-build demand aggregation program where they go into a community, they find champions, they set up information meetings, and they convince 30% of the population to sign up to take services, and on that basis, they then start digging. There's no speculative deployment of capital, there's always a commitment, or at least a very strong signal of commitment. Based on this formula, they've been able to attract investment from KPN, which gives the investors a nice exit. They've also attracted a significant amount of debt from the EIB and a consortium of Dutch banks. Seems to validate this model. As I've said, in this case, you know, it doesn't hurt if your founder is a billionaire who owns a construction company. Not everyone will have that benefit, but we do see some examples where people are trying to replicate elements of this in specific market niches. It's happened. So we're starting to see a number of companies who are emulating to some extent this approach. Hyperoptic is a UK company founded in 2011. They deliver gigabit services, but slightly below that as well. They have a light product to compete for low-intensity users, but they target strictly large-scale multi-dwelling units. This is Albion Court or Albion House, I can't remember what it's called. Massive development in London. This is their niche. They either form an anchor relationship with the landlord or the tenant association, or they go bottom up through marketing to build demand aggregation to a level of uptake where it justifies the investment. Again, it's not the build it and they will come attitude, it's securing the visibility of revenues before any capex is committed. They currently target over 500,000 households over the next 5 years. That's only 2% of the UK households. But amazingly, I was talking to someone in the break, some of these new buildings, you would think, being recently constructed, they would have fiber already in the building. No, they have copper for some reason. So there is a market there to be attacked, which they're attacking. And there's a Hungarian man named George Soros, you might have heard of. He invested 50 million pounds in this business earlier this year. There's a company at the opposite end of the spectrum called GigaClear. Again, entrepreneurial capital being put to work. They target very small villages, typically sort of 200 to 300 households in rural England. Now, the point was made earlier that we can't justify building fiber to cottages in the middle of the Scottish Highlands. I agree, but if you've ever been to little villages in England, the housing density, linear housing density, is not significantly different than it is in some of the suburban areas of major cities. So the actual cost per home passed for deployment there is not materially different than in an urban environment. That's the niche that these guys have discovered. The bigger challenge often is getting backhaul into the point of presence in the local village. But in areas where that does work, they're able to deliver, and they've got a proven track record. They're active in 9 communities today. They again require 30% pre-commitment with a £100 deposit paid, so people have some skin in the game before they actually deploy. I reckon there's 1 million to 2 million homes in the UK that they could target successfully. But again, we have to talk about scale. If you combine their potential target market with the previous companies, it's still only 10% of UK households. So none of these is going to be a universal panacea. It's not going to destroy the incumbent. It's not going to displace the status quo, but it is taking advantage of some inefficiencies in the market to provide a third way. A lot of these villages are very affluent, by the way. They don't have cable. They have very poor DSL. People are willing to pay a premium price for connectivity. City Fiber, how am I doing on time, Magnus? Thought I'd check in. 3 minutes. City Fiber is a company, a new company formed in 2011. Shareholders here acquired legacy fiber assets from a company that blew up. That has fiber in 50 different cities and towns in the UK. Their model is to sign an anchor contract with a systems integrator or a service provider which services the public service network segment. So you have to be an approved provider on that platform. So they become a contractor to the service provider, who is then servicing the anchor tenant, which is the local government. The ownership of the network itself is retained by City Fiber. Typically, the contract value covers somewhere between 70 to 100% of the capex required to build the network. Therefore, you get a decent recovery from just the anchor contract itself. But the amount of fiber consumed is usually less than 5% of the total capacity in the network. So there's this abundance of fiber in the ground that can then be exploited through other commercial arrangements with mobile operators, service providers. In York, which is their biggest, the medieval city of York, their biggest network, it's currently 111 kilometers, 179 endpoints being serviced. Most of those are public sector, but they're beginning to launch in partnership with Level 3, a lease line service for businesses, which they're starting to see uptake on with virtually no marketing because of the dearth of fiber in this market. They recently signed a contract with Serco, which is another service provider in the public sector space, for a similar dimension network in Peterborough. You could argue that this provides a nice platform for eventually building out to a residential distribution network for fiber to the home. That's not on the cards, it's not in the plan at the moment. But again, this is another sort of variation on the take of not deploying capital until you have an anchor customer in place. What have I done? Oh my God. Help. Ah, thank you. The unseen hand from the back of the room. Lastly, in Germany, obviously Germany's had a lot of very, very widely publicized activity from local Stadtwerke, local utility companies, but the state of the market there is very similar to the UK. There's a group of industry veterans from the telco industry, from the systems integrator background, and also from the financial fund industry, who've put together this BB Glasfaserfonds, which means fiberglass fund, which is basically a greenfield infrastructure fund, built really with a view to bridging this gap in areas that are not served particularly well by cable and have poor DSL as a result. They've identified that there are 1,400 communities in Germany which would fall into their investment parameters. They would prioritize the deployments there on the basis of projected ROI. They so far have significant traction with a lot of the incumbent service providers who currently sit on the DT network. The view there ultimately is to, on a local exchange by local exchange basis, to migrate materially all of the existing DSL and PSTN customers onto an all-IP fiber-based network and eventually decommission that part of the local network. Very ambitious, very interesting to see how it plays out. But again, based on the basis that this formula is successful, then there will be successful, significant mitigation of the build risk. In summary, it's clear that two of Europe's leading economies are way behind where they should be in terms of broadband infrastructure. It's hardly commensurate with some of the other aspects of their importance politically and economically. There's an investment gap of tens of billions, which the incumbent guys are just not going to can't do it, even if they wanted to, you know. The gap really needs to be plugged by third-party entrepreneurial capital. Scott Marcus made a very good point earlier about cable not really getting its due when it comes to performance. It's interesting to remember Virgin Media, which is the cable company that covers half of the UK, is one monolithic company today. It started out as over 100 individual cable franchises. Some went bust, some got sold at very nice profits. You know, if it hadn't been for that risk-taking, initially we wouldn't have the cable infrastructure that we have today to point to as a success story. Also notably, when those cable networks were built, there was no internet that could even form any part of their business case. So putting that infrastructure in place created option value that created an entire segment of the industry that no one envisaged before. So when we get to questions about who needs fiber, why would you need it, what could you do with it, take cable as a salutary lesson. You can't predict the future with that much clarity. Lastly, I think the successful models in this space will be those similar to what I've indicated here, who have significant levels of pre-commitment either from end customers or from service providers or local authorities to justify the build and to mitigate the perceived build risk involved. One thing I've encountered in dealing with private equity and infrastructure funds is that the infrastructure guys say, I'd love to own a fiber network as long as it's built and fully populated. So come back in 10 years. The private equity guys say, yeah, we love it, because it's an analog, it's an analogy of the cable networks. It could be the same thing all over again, but we have to be out in 5 years, you know, because of the cycle of our funds. So again, come back in 5 years and we'll buy you out, or there's a disconnect between the durations and the nature of capital available out there and the nature of this investment, which is, as we've seen earlier, a very long duration, long-lived asset. So I think where we need to get to is educating investors that this is a legitimate form of long-term infrastructure, like a toll road, like a dam, like a parking lot, and that they can invest in that with confidence if the right ingredients are there. We've got a lot of work to do. Thanks for your attention.
Thank you, James, and indeed a very different perspective. Lots of food for thought again. We're all waiting for other types of food. I would love to miss the opportunity for questions if there are any burning ones, but we'll just do a few minutes and then we'll go to lunch. Do we have any hands? tummies are rumbling. I encourage you, as with the morning panel as well, to pick up the speakers if you want to discuss elements with them. I think everyone will be around for the rest of the day. So, unless there are any questions? No? Oh, there's one. Okay. That'll wrap us up. Thanks.
Actually, I think the second half of that presentation was very interesting, and I think we can welcome all of those kinds of interventions. I think the first half, I'm afraid, was almost complete nonsense. Sorry to have to say that, but I think this debate suffers sometimes from sloppy thinking and poor use of language and light analysis. So if you look at the UK, I can't speak for Germany, but I certainly can speak for the UK. There's very good fibre rollout. The regulatory framework, which Stephen alluded to, was the one that was put in place some years ago, in advance, I think 2 or 3 years in advance of the Commission's adoption of the same approach. That's led to rollout, not just to the cable areas, as you suggested, but now to 75% of population covered of fibre to the cabinet, well in excess of the cable rollout position. That will deliver to 90%, in excess of 90% in the next 2 years or so. So cable upgrading to speeds of well over 160 it is now. Fibre to the cabinet up to 90, probably 95%, and with a target to go beyond that within the next few years. There's an evolution path to G.fast beyond that. There's an evolution path to fibre to the home beyond that. So I think we've got to be a little more reasonable about the evolution of what is efficient investment in light of the costs and the returns available, and in light of demand. We're not awash with evidence that demand for a gigabit a second is out there for all new residential consumers. We know about the lease line market, it's completely different. That evidence on the demand side just doesn't exist. So a sensible approach is to go for an efficient investment model, and that is to very wide availability, which I think is exactly where the UK is. If there is an opportunity for that kind of private capital to come in and take a risk by introducing fibre today, that's fantastic, and I think the second half of the presentation for that reason was very interesting. As you probably know, we would welcome that. But just to illustrate the point, you referred to Spotify and Twitter, and that they wouldn't emerge in the UK or Germany because of those rollouts. I do think that is absolute nonsense. Spotify and Twitter and any of those kinds of services do not need fibre to the home for their service or for their development. They were not developed in a context where everybody had fibre to the home. And statements like that just are not right. And I think the issue, one of the things which hasn't been picked up in a lot of this discussion this morning, is the relationship between that infrastructure built out, between network operators, both mobile and fixed, and where an awful lot of the value that was described earlier on by the A. Little guy and the BCG guy, which is dominated by those over-the-top service players, where the question about why Europe doesn't have those is not, it seems to me, fundamentally to do with the amount of infrastructure a network operator has built. It's a different set of questions, a very different set of questions about skills, about education, about entrepreneurship, about availability of capital, and all of those sorts of things. And to elide the two, I think, is really quite mistaken.
Right. Lovely comment to wrap up on there. You can take it offline, I think, over lunch. Let's come back in an hour. So we have 2:40. We'll be back here. Thank you and enjoy lunch.